Hi, and welcome to my first study session that I've ever filmed on this channel. I am a beginner trader. I'm learning how to trade, and I came across the WAM method by Kelly Ohgee. It's not a trading strategy. I haven't swapped strategies. I trade ICC by Trades by Sky, but this is just kind of like almost a beginner's guide to like the way the markets move. So what I did is I downloaded the PowerPoint that she has. She has the PowerPoint for free. I'll show you guys quickly where you can get it from on this video here. And if you scroll down into her description, you can get a free copy right here. But I'm going to link it in the description so you guys can get access to a full copy yourself. And I'll show you guys what I basically studied. I have a book here where I've taken heaps of notes, but I'll show you basically a simplified, summarized version of my notes in a cute little presentation, which I haven't done on this channel before. But anyway, let's start. So the WAM method by Kelly Ohgee. WAM stands for what are the markets, the audience who's playing. M is for the market, like the bigger picture. And the WAM method, oh my god, the WAM method is supposed to turn confusion into clarity. The market is more than lines and boxes. It's got an entire ecosystem behind it. Obviously, I've been live trading. I already know a lot of this stuff, but she has summarized it in like the most perfect way. Like, she's done it in such an easy to understand way. She's used so many incredible analogies, and I feel like it's always good to revise on this type of stuff just so that you can, recite it off by heart, like the way the market moves, which I could do to a point, but having the analogies helps me have a deeper understanding. Think of money like water. This is what she says. Think of money like water. Money flows from person to person, company to company, and country to country. So the stock market, no, what am I saying? The market involves the stock market, forex, and options, and they're all like different channels of getting money. So the stock market is like owning one brick in a massive skyscraper. I love this analogy. I never thought of this before, and I think it's great. Obviously, the stock market includes like your Apple, your Tesla, all those things. And then if a company grows, the price goes up. If a company oh my god, if a company struggles, price goes down. And Kelly says it's all about supply and demand. And we all know that supply and demand is a pretty common trading strategy. It's not what I trade. I guess I use like a little bit of supply and demand. I feel like everything's kind of the same when it comes to trading. Like everything pretty similar. Like I've heard that supply and demand zones are like order blocks from ICT. And I guess supply and demand are pretty similar to support and resistance. But I haven't looked into the supply and demand strategy because I don't trade it. But Kelly says that it's all about supply and demand. And again, I've just put here, download her detailed PowerPoint link in bio, because her detailed PowerPoint goes through it like to a T. Like I obviously don't want to copy it word for word. Mine's just a summarized version of my notes. So companies sell their own stocks to raise money to invest in their growth. IPO, so the initial public offering, it's like a company's first day of school. I think that's so cute. That's pretty much obviously when like a company comes onto the stock market and is like, hey, we have these stocks. You guys want to invest in our company? And yeah. And then an index fund is like a basket of stocks. So that includes the S&P 500, which is all the US companies, all the top 500 US companies, the NASDAQ, which is focused on tech and innovation, and the Dow Jones, which is the top 30 blue chip. I think the Dow Jones doesn't have as crazy of growth as the S&P 500, but I think it's a very, very, very safe investment. I think this is not financial advice. This is not financial advice. So the foreign exchange market is where money trades itself. So it's the world's biggest market, and there's $7 trillion traded daily in it, which is absolutely insane. But obviously, it's like exchanging the US dollar for the euro dollar, European dollar. I don't know if I'm saying that right. But yeah, then you profit on the difference of whatever holds more power. So if the US market is crashing like it is today, I mean, it's not really crashing because I'm pretty sure NQ is pushing all-time highs. I don't trade NQ or ES, so I wouldn't be the most familiar. But as we can see from like the economy in the US shutdown and things like that, the US dollar is weakening. Actually, I was looking at the US dollar index. It should be weakening. That means that anything that's against the US dollar should, in theory, go up. Option. I don't trade options. Kelly trades options, so she has a lot of stuff about options in here. I love learning about options because I can't really wrap my head fully around it. She has a great way of explaining it. Options, she explains it like a ticket to trade, but you don't have obligations. So a ticket to trade at a later day is basically like securing your spot to buy a ticket at $50. And the price might go up to $200, but you can still buy it at $50. If that makes sense. She explains it really, really good in her PowerPoint. But you obviously don't have the obligation to buy it or sell it or like place your order. But options come with like a time constraint, and if you don't buy or sell or place a position in, then your option contract, your ticket can expire, and then you'll lose all your money. So yeah. And then when you are using options, you obviously have shorts and longs normally when you're trading, which a short would be, you're profiting off of the market going down, a long would be you're profiting off of the market going up. So if you're trading options, you would place a call, which is a buy, which is a long, which means that you're betting on the price going up, or you place a put, which is to sell, which means that you're shorting, which means that you're expecting the market to go down. So How price changes is supply and demand. So if good news drops, then price could go up. If everyone wants in, so in bull markets when prices are just soaring, then everyone wants a little piece of that pie and they enter late. And then that's pretty similar. Prices rise, the markets rebalance, and people take profits. And price doesn't move randomly at all. It moves because of human emotion, news, expectations, and reality. So I'll go into a little bit of this later, but news is obviously your PPI, your NFP, your power speaking. Expectations would be, I guess, what's called rate cuts would be like an expectation if you're betting on price moving in a certain direction because you're betting on the rates cutting. Because there's always like when the rates start to cut, I've noticed in the podcasts that I've listened to, they'll say like, oh, it's a certain percent chance that the rates will cut, and then if it's like and then if you're placing a trade based off that, you'd be basing it off of expectations. I think I explained that right. And then reality would be like your wars, your pandemics and stuff like that, and human emotions. We'll get into that later. So your audience, which is the A in WAM. So who trades it and why? So we have institutions, aka whales. So that's your hedge funds, your banks, your like just people that are placing massive positions and they have access to like so much money, like millions of dollars, where they're able to literally make the markets move. So if they place a position in a certain way, they can literally cause a massive drop. But they're also the ones, I think in the second one of Kelly Ohgee's books or presentations, she has one that's about like reading the markets like a storybook, and she talks about how the institutions are like the directors in the market, and they're able to direct price and they're able to paint a narrative with it. That's where you get your liquidity sweeps, your fake outs and stuff like that. Retail traders is us, so we're the ones that look at these candlesticks and we look at trends and stuff like that. It's just traders and swing traders basically, it's retail traders, and just like your average like person who just buys and sells for the sake of it. I don't know if you guys have any of those in your life, but I know a few people like that. And then companies, so Apple, Tesla, Walmart, they're the when I was talking about before, where companies where you can trade money from company to company. I think a while back when I was saying that, when I quoted how Kelly was talking about how money is like water, and then governments and central bank. What am I saying? Governments and central banks. What a audience. Okay, governments and central banks. So they're obviously the ones who I don't know how to explain it. Some companies will buy their own stocks to increase its value. I didn't know this. It's called a buyback. I did not know that at all. So why do people trade? It's to grow wealth by compounding, so that's your long-term investing. Speculating, which is quick gains, which is your day trading, swing trading, like us. And then managing risks, protecting profits. Okay, wait, hold on. Companies, they will put money into the forex exchange market, commodities and things like that to secure their profits so that their profits don't get affected by inflation. There you go. Managing risks, protecting profits. I'm pretty sure that the government does that as well, where they'll invest in certain things, avoid being affected by inflation. What influences their decisions? Economic reports, company earnings, interest rates, and global events. So economic reports is like your CPI, your GDP, your unemployment rates. GDP is gross domestic product. Did I get it right? I did. And then if inflation is higher, then Feds might cut rates and stock prices may go down, but gold may go up. I just say that because I trade gold, so if you're a subscriber on this channel, you would know that all of my trade recaps, everything is all on gold. So that's why I had to include that in there. So interest rates, higher rates is expensive borrowing, companies spend less, and stocks fall. So higher interest rates means that when you go to borrow money from the banks, you have to pay more than if the interest rates were low. Therefore, not only companies spend less, but people spend less, because if there's higher rates, it usually indicates that inflation is high. I'm pretty sure. Again, this is not financial advice. This is just me and what I learned from Kelly Ohgee's WAM method. So higher interest rates is expensive borrowing. Companies spend less. People buy less houses. People spend less on cars, and stocks will fall because obviously, if people aren't buying Ferraris because the rates are really, really high, then the Ferrari stock is going to go down. I don't know, I think I explained that right. Company earnings. So each quarter, companies report earnings. If they beat expectations, prices go up, and vice versa. So if they perform worse than expectations, then the price will go down. And then global events. So you've got your wars, your natural disasters, your pandemics, and uncertainty shapes the market. So if price is uncertain, then markets are going to go crazy. Not particularly, but like they're just going to be unpredictable. Emotions in the market. So you've got your greedy investor, which is, hold on. So your greedy investor is, everyone's making money, I need to get in before I miss out. So it's your FOMO, it's your forcing trades. And then the fearful investor is, oh no, it's dropping. What if it goes down to zero? I need to sell. So that's your exiting early, moving your stop losses. What's more? Revenge trading. I guess that's greedy as well. And then you've got your rational investor, which is what we all want to be, which is the markets go up and down. I invest money I won't need, and I'll stick to my plan. I invest money that I don't need, so I'll stick to my plan. think that's better. So yeah, it's your good habits, your disciplined, you're journaling your trades, you're just trusting your system. That's your rational investor. So that's what we all want to be. So M in WAM is markets. So it's 100. The global stock market is, I don't know. Wait, I don't know. I wrote these notes wrong, but there's $100 trillion in global stock markets. I think daily. No, not daily. I think overall, and then 7 trillion daily forex trading transactions that happen, and then there's 500 billion daily options volume daily. And the forex market represents economic strength, and then options reflects expectations. So how people make money in the market is long-term investing, options income, active trading, and forex trading. And then obviously most of us are going to be in these three, whether you trade options, the stock market, forex. It's all these three are pretty similar. It's you're capitalizing off of the short-term fluctuations of the markets, unless you're hedging with options, which I don't think much of us will be doing. And then long-term investing is obviously you've got your investment portfolio, you've got a certain percentage in the S&P, you've got a certain percentage in gold, you've got a certain percentage in X, Y, and Z. And then the economic forces, so that's inflation, your interest rates, your GDP, and unemployment rates. These kind of repeat themselves, I'm not going to lie. I noticed that when I was writing down my notes. It's the same kind of format as the PowerPoint. Like I'm kind of going in the same order. So obviously these four things are very important in the markets, and it's very important to understand them because they have a massive effect on the markets. And I've really noticed that recently, like with the interest rates being cut and everything, like you can really tell. So how options fits into all of this is you're betting on volatility, not just direction. So that's how you get those really big turns on trading, because you're not just trading on the direction and on the actual dollar amount that a stock goes up or yada yada yada. But you're betting on the direction and also I think it's the market sentiment. She had a better word for it, but I guess the expectations. And then big funds use options to hedge, which is what I said before. So say they bought a certain amount in Apple, they're going to buy a certain, what's it called, a put options contract to hedge it, so that if Apple drops and goes down a lot, then they won't lose as much because they've got the stock option they've invested into. So retails use options for leverage, like I said before. So because you're not betting on the direction, you're betting on volatility. Oh, that's the word I was looking for before. It was literally right on the screen. Betting on volatility, not just direction. So you're betting on the momentum. And then, that's how they get like big returns, because you're not just betting on the direction and the dollar amount. You're betting on like the volatility and the momentum and the expectations. And Kelly Ohgee says, the simple secret to winning long term is you don't need to be a genius. And that is literally it. That is literally it for my presentation for this study session. If you want to download the PowerPoint, which goes way more into depth than this video does, I was literally sitting here for so long watching through this PowerPoint and taking notes. It goes so well into depth. It honestly helps so much. I'm going to have to go through it a few more times so that I can recite it even better than I did today, because there's obviously areas where I don't have the most deepest amount of knowledge, especially when it comes to options, because I don't trade options. I feel like this WAM method, it really does help you get an understanding of the way that the markets actually move, and you understand more than just the candlesticks on the chart. But this is the first study session, so please don't judge me. I know that sometimes I cannot read the best. Sometimes I jumble up my words, and sometimes it sounds like I don't know what I'm talking about because the words, they mix up in my head. But I don't really have anything else to say. I'm going to do a trade recap and a trading diaries episode later today, and gonna do more studying. I hope you guys enjoyed this. I hope you gained something out of it. If not, I strongly recommend that you download the WAM method by Kelly Ohgee. Kelly Ohgee is really amazing. She's an amazing trader. She hasn't been that much into the trading space at the moment. However, she did just post a video which I watched immediately when I saw it. She's the person who learned how to trade in 2 days. That's what she's very well known for. But I hope you guys enjoyed this video, and I will see you later today. Bye.